I'm Charlotte McLeod with investingnews.com, and here today with me is Josef Schachter, president and author at the Schachter Energy Report. He's also a 40-year veteran of the industry on both the buy and sell side. Thank you so much for being here. Always great to catch up with you.
Glad to be with you again, Charlotte. And to all your listeners and viewers, Happy New Year to them. And I hope they had a nice holiday season.
Yes, well, thank you so much. Happy New Year to you as well. Definitely, we've got a lot to get into today. And of course, we'll take a look forward into what's happening for oil and natural gas in 2026. But before we do that, I thought we could take a look back at 2025 for the oil market. I remember we did this conversation, I think almost exactly a year ago, and you were quite bullish on where prices could go in 2025. Of course, that outlook was adjusted throughout the year. But I'm wondering, if we look at oil prices, what was it that kept them lower than at least initially expected in this past 12 months?
Yeah, we started the year at $79 WTI, and a lot of people were in the companies were using $80 oil in their forecasts. And we started seeing weakening demand in the United States on the consumer side. And then we had the tariffs. President Trump came and took a 2x4 to global trade. And that really knocked things off. And we got cautious then. And we said, we're going to have a correction. And we thought we would get below 60. And so we said that could happen, in the coming months. And in March, April, it did happen. And so we have three things we watch for our buy signal. One of them, the price of oil getting below economics. And so the Federal Reserve of Dallas puts out a sheet talking about all the basins in Texas. And the average they need is about $65, some down to, the 50s, some in the 70s. But the average is about 65. We were down, as you know, at $54 or $56 in April. The second one is the S&P TSX Energy Index. We thought it was trading in the 290s, and we thought it would go below 240, which it did. And it even went lower than that, went down to 214. So that was, the second one we needed to check the boxes of saying we have a buy signal. The third one's very interesting. It's the emotion and bullishness to the sector. So there's an index called the S&P Energy Bullish Percentage Index. And in January, that was at 80. And then historically, it can correct down to, below 10% to give you a buy signal. Anytime below 5%, it's a table pounding buy signal. So in 2020, it got down to like 3-4%. 2008, during the financial crisis, it got down to, 3-4%. This time in April of 2025, it got to 0%, the lowest number ever recorded. So we said we have all three of our check marks for a buy signal, table pounding buy signal, and we sent out an action alert buy, sent out a lot of recommendations on the buy side, and it's been a fabulous year. Everybody talks silver and gold and how well they performed, but I can walk through names here and just show you how well they did. Birchcliff, which is a name you and I have talked about, it was $4.71 at the low. It's $7.56 now. You can go to names like In Play Oil. It was $6.54. Now it's $12.25. Strathcona, which is an oil name, $22.75, got up to $45. So there's some great performances here. And there's dividend yielding stocks that did well. We can talk about that. So, the idea is that New Vista was a name we put on in April at $11. Ovintiv is in the process of taking them over at 18. So there's been some fabulous performances in the sector, 50%, some doubles, even in a year when oil was lousy. And natural gas is just now coming back to life at, $3.15 for AECO, but $4.60 for NYMEX. So the natural gas stocks, because of LNG Canada and the export market and data centers, the natural gas stocks have done exceedingly well, and some oil stocks have done well. But I think the sector is really attractive for people, for the long term. But I think we're going to see a bit of a correction in Q1. And so we're going to be, putting out a buy signal when that happens. Today, the price of oil is, just under 58. The S&P TSX Energy Index is in the 298 range, and the bullish percentage index is 49%. So it's down from 70 to 49. So it's got a little way to get below 10%. So we're going to see this correction unfold. and January, February, March. When the buy signal happens, we'll send it out. We've been recommending investors that whatever your target weighting is for energy, and again, people in Eastern Canada may not want as much energy. People in Western Canada would want more. So we've been saying 80% of your target level is where you should be at. On this next buy signal, we would say it's time to go to 100% of your target weighting. Now, that might only be 2 names. If you have 30 names in your portfolio, if you're in Western Canada or Alberta, you might have 8 of your 20 names in energy. Again, each area, people have focus of their portfolios and comfort zone. The other thing is you can get great yields in the sector. There's a lot of companies even today yielding over 7%. So if people want dividend income and capital gains, that's where our personal portfolio is, where you want to get names that give you a payday while you're waiting more than the bank pays you. And we're looking for upside, as the volumes grow, as we get the higher commodity prices, cash flows will grow and multiples will expand. Many companies today are trading at 2-3 times cash flow, which at the top of the cycle, they'll trade at 8-9 times cash flow. Many of them are trading at a third of NAV and 2p NAV. And, there's a thing called PDP, prove, develop, producing, then 1p and then 2p. 2p is proven plus probable. And so at the top of cycles, you trade at 2p. So we're trading at PDP, like a 1/3 of that number and the upside is still there. And if you add a higher commodity price and higher production, you just get higher and higher numbers. So I think there's many just like people, 2 years ago looking at the golds and silver stocks and saying gold's moving, silver's not. But, the stocks are cheap. Well, we saw in 2025 how fast they can react. My view is that there's a lot of 3, 4, 5 baggers in the sector between now and the end of the decade. And so we think that this is a sector that people should have exposure to. And people, there's the gold stocks really don't pay dividends. Here's a way to get paid while you wait and have the upside potential of doubles, triples, or more. And that's what we look at in our universe is we look at, companies that are dividend payers with moderate capital gain potential. Then we look at growth stories, and then we look at entrepreneurial names that could be the 5 and 10 baggers. So we try to get a mix of names depending upon what the client's risk profile is and what they're looking for. And then we cover domestic energy, international Canadian companies working overseas, energy service, and the royalty companies, so that people can have depending upon their risk profile, portfolio needs. We cover 31 companies. We lost 3 this year with takeovers, New Vista. We lost Kuwaitno, and we lost Step. So January, the next issue of my report, we'll be adding a new natural gas story that we think is very cheap and compelling for investors. So we're in the process of doing more research and bringing on some new names. So it's a fun time right now.
It does sound like a very fun time. And I think a lot of our audience who is interested in gold and silver will really respond to the analog that you're drawing there. So it sounds like there's opportunities all up and down the chain for oil and natural gas companies. I wondered if we could set the stage a little bit more for 2026 in terms of prices. You're mentioning perhaps we see the low in Q1, and then what unfolds from there? How are you looking at it let's start with oil. Let's talk about oil prices.
Yeah, oil prices, as I mentioned, we're just under $58. The low for the year was 54 just a few weeks ago. I think we're going to be looking at Q1 a little bit lower, 52 at the low end, and 66 in Q1 at the high end. Q2, we start seeing a better pricing environment, and I'm looking at 62 at the low end, up $10 from the low end in Q1, but I'm looking for 72 on the upside. So we're starting to peak over 70. That wakes the industry up. That wakes people interest in the sector up. It's like gold going over 2,000 or silver going over 50. People wake up when that kind of thing happens. Q3, we're looking for inventories to start coming down globally, demand to pick up. People realize OPEC has not got more production coming on, and the inventory story, which is total garbage. You hear people saying there's a $3 or $4 million, million barrel a day excess capacity out there. I think that's totally false, and I can go over that with you. If you remember when it was $79, everybody said there was a shortage of oil in January. So, the narrative changes. When the price goes down, they make a more bearish story. And when you're $79, they give you the bullish story. And so, I think in Q3, we're going to range between 68 and 78. And then the real progress will be made in Q4 when I have a range of 74 to 84. So once we peak over 80, I think multiples will start expanding. And people will start putting in, $80 go forward for cash flows. What does that mean? Companies with growth will start profiling their growth prospects. And I think we're going to see big changes in terms of price, be from the low that I see coming in the months ahead, and even from where we are today, going into the end of 2026. So, I think in the beginning of this 2025, we had the high price, we had the low price in December. I think we'll have the low price in January, February, the high price in December of 2026, and then going higher. I think before the cycle is over, the 2008 high of $147 will be breached because the industry cannot respond quickly to bringing on new oil. Think about an offshore discovery. It may take 10 years to put facilities on. Onshore, you may have a discovery. We have lots of gas in Western Canada. The problem is we have no pipelines and no LNG on the coast. So if infrastructure becomes an impediment to the growth, which means you're going to have a longer bull cycle because it takes time to build the infrastructure to move the product to market. And, Asia is going to see a lot of demand growth, Japan, South Korea, China. And if we are going to have more data centers and we're going to have more of the grid improved, you're going to need more copper, nickel, aluminum, zinc, rare earths. And to bring that in the third world, they're going to use more energy. And the people who are working in the field, in those businesses are going to need more energy. They're going to want to have heating in their houses. They're going to want to have, electricity. They're going to want to drive cars. And so, consumption is going to grow, not in the OECD in the next few years, but the growth will be in the non-OECD. And that's what the driver is going to be. And I think that's going to cause demand to go from, let's say 105 million, 105.2 in 2025. I'm using 106.3 as my number for 2026, but that number could be 112 by the end of the decade, 110 to 112. And it's all because of the third world that's going to bring on the resources that we need for moving on all these issues, be it data centers, improving the electricity grid, and then, all the things, even military applications. Trump's got a new battleship or two that he wants to build, and the drums are still on in Europe. Military drums are still happening and the war is still on there. China's talking about doing things with Taiwan. These geopolitical events can have a big increase in the price of oil. We got up to 120 when Russia invaded Ukraine. In 2008, we had massive, strong economic demand. And the inventories went down to low levels. So we went from $90 to 147 in 3 months. So, and it's, just think about gold and silver, the trajectory in the last few months. People should think should know that can happen to energy. Just pull out the long-term charts for stocks or for oil prices, and you can see that.
Well, and speaking about the geopolitical impact on the oil price, I'm seeing a lot of the headlines right now about the US-Venezuela situation and what it could mean for the oil market. How would you break that down for investors?
Well, the American companies were there, and ExxonMobil, ConocoPhillips, Chevron, BP, Total, Repsol, Eni, all of them were there. And then in 2005, Chavez nationalized the industry, and it was producing 3.3 million barrels a day. So those companies say they want their assets back, and that's why you're hearing President Trump saying that they've stolen our oil. And so, they're producing now about 900,000 barrels a day. So could they go back to 2-3 million if the American companies and the international companies get their assets back and can increase their production? Yes, they can. So you go to the flip side of it. Canada in 2005 was producing about 2.5 million barrels and was shipping about 1.5 million to the United States. Today, we produce 6.1 million and we ship 4.2 million barrels to the States, of which over 3 million is heavies that go into the middle part of the States and down to the Gulf Coast. So if those companies, the American companies that would get their assets back in Venezuela, and they have refineries that they own in the Gulf Coast, they could be bringing their own oil from Venezuela into the markets there on the Gulf Coast. And that means Canada may lose production into the U.S., which means why we need takeaway capacity on the East Coast. So TMX can maybe take another 400,000 barrels, maybe with another expansion a little more. But the reality is we need at some point an additional takeaway pipeline to the West Coast. We can do rail, but I think most people would say rail is stupid, because of the environmental concerns, derailments and things like that, which we've seen, and all the problems with that. So to me, I think Canada's heavy oil industry is the least attractive to me of all of them. Light oil is attractive. Natural gas is the most attractive. So when we talk stocks, I talk mostly about natural gas and natural gas liquids and light. And then when people say to me, why don't you talk about heavy oil stocks? I say, we only cover one, because it was ridiculously cheap that was Strathcona. And most of the time, we really don't cover that sector because we're concerned about long-term market access unless we get more takeaway capacity, which, given First Nations are against it, Premier Eby is against it, the Prime Minister is not so keen on it, even though he's saying we have an MOU, but he wants carbon capture first. So you don't have everybody on the buy-in. And right now we have the buy-in on natural gas. The First Nations are there. They want to own part of it. They want to own some of the pipelines related to it. So we've got buy-in from them. We got buy-in from EB. We got buy-in from the legislature in Victoria. So government of Canada, the companies, everybody's on side for natural gas. The oil side is still, has transaction problems. Growth problems.
Yeah, you can see the differences in the situations there. And in terms of oil, I also, of course, wanted to bring up OPEC, always a hot topic. I believe the last time that we spoke, you were talking about how OPEC is getting close to its full production capacity. And I'm wondering if you can share what you see coming in 2026. I know also for 2026, OPEC is believing that we're going to have a balanced market for oil. So just curious what you see coming there.
Yeah, OPEC, as you remember, was adding 143,000 barrels a month, and they haven't been able to increase the production at that rate. So it tells you that the basins and that the money being spent to increase production is not there. In the month of November, which is the last data that I've got in front of me, OPEC produced 28.48 million barrels. And it was down 1,000 barrels from the previous month. So they didn't add 143. Saudi Arabia increased production by 54,000, but you had Iraq down by 21,000, Iran down by 19,000, Nigeria down by 11, Venezuela down by 27. And now, with what Trump's doing now, that's going to be much lower too. So OPEC has really not had the ability to fill the market, as it grows. And so if you have more production from, the United States next year, Guyana, offshore Brazil, maybe that's 500,000-600,000 barrels a day. But if demand grows by 1.1 to 1.3 million barrels, that's going to be the drawdown on storage around the world. And that to me is how you drive the price of oil higher. And just to go through the numbers on storage, which is really the issue, people say that there's too much oil and there's 3-4 million barrels. That's the bear's view. You've got three areas you want to look. The biggest consuming market, which is the United States, which is 23.5 million of production, and demand is 20.5. They have commercial stocks last week were 424 million barrels. That they have a 5-year band of 400 to 500. So they're at the lower end of the band. So the United States doesn't have a glut of oil. Onshore global commercial stocks were at 4.4 billion. That's the lower end of the global 5-year range of 4.4 to 5.1. The only one that's above is the offshore on the water inventories, which is where the shadow fleets from Iran, Venezuela, and Russia are looking for markets. That's at 2.3 billion barrels, and the 5-year range was 1.7 to 2. So it's 400 million above. But when you take into account that the Americans are way below and the global numbers are below onshore, that tells me that there really isn't a glut except in one particular area. And, if Russia does a deal with Ukraine and sanctions come off, then that can move into the market. If it goes into global inventories, then, we're still within the range bound. And so to me, as we start eating into those inventories in second half of 2026, everybody's going to wake up to the fact that the industry can't increase production easily. If you find it, it takes a while to bring it on, in terms of pipelines and facilities and all the rest of it. So I think that we're going to see a very strong market in the second half, as I mentioned, and I think that continues into the years ahead, as people, as we talk more and more about data centers and AI and all of that. And then the grid gets tight and, all of a sudden you have brownouts, where the electricity is not available. If you remember, even in winter of last year, we had times when, Alberta would put out warnings saying, please don't use electricity because the grid's at capacity. So, don't put on the lights if you don't need to. And so we've had those warnings in Alberta already. And I think we're going to see that happen in Ontario, Quebec, and, right across many of the industrialized countries where the grids are at maximum and the industries have not spent money upgrading the grid or expanding the grid because they haven't had an attractive opportunity until data centers showed up. And then they woke up and said, oops, we got a problem here. And they've got to start spending money. And so, they're looking at, nuclear, small reactors there. They're looking at more wind and solar. But those also take time. And, small modular reactors, we still don't have, it fine tuned to what the right facility is needed, and they can be built in a reasonable period of time. So natural gas becomes the one that benefits from it, because it's we have pipelines, we have everything available. And so, if we want more electricity capacity, natural gas is going to be the home run winner. And, US, as I mentioned, we're 460 something for US NYMEX. That could be 5, 6, 7 during periods of cold weather or when demand is very strong. It could go to 10. That really leverages profitability. And on oil, we're right now, as I said, $58 range. If we get up to 80 by the end of this year and then, 100, 120, 3-4 years from now, all of that's going to leverage into cash flow, give the companies the money to spend on growth. And of course, if you have a choice of buying from Russia or Saudi Arabia or United States and Canada, I think you're going to choose United States and Canada. The U.S. is the biggest producer at 23.5. Saudi Arabia is just over 10, as I mentioned. Then you go to Russia, which is about 9.4, and then Canada 6.1. Then it drops down to China at 4.3. So we're the fourth largest producer of oil in the world, or liquids in the world, and we have a big natural gas growth business. So Canada, from being unattractive under the Trudeau years, is now becoming okay. And maybe let's check Carney out and see what happens. But that could become where people realize Canada has the ability to grow to 8 or 9 million barrels a day, 10 or 15 BCF of export LNG in the next few decades. All of that is a very, very positive. And you've seen Tom Hodgson, our energy minister, talk about energy and other areas of the resource sector becoming the boom or the wealth creators for Canadians. And I think that has finally gotten across to Carney. And of course, if this Venezuela thing is serious, as I think it is, they'll realize they need new markets because the American, U.S. market may not be there for us. If the American companies are able to bring their own oil in from Venezuela in, 2-3 years from now.
Yeah, very interesting changing situation for Canada. And also I find it very interesting, the data center demand for natural gas. There's so much focus, as you mentioned, on nuclear for that, but interesting to see how natural gas can play a role. Anything you would add in terms of demand for the oil side? I feel like there's always, for oil, a lot of focus on what's happening with supply, but anything you'd note on demand for people to take away?
Well, on the demand side, we all think of gasoline and diesel and jet fuel, but they don't realize that a lot of the things that oil produces, be it the polyesters, be it, be it my glass frames, be it, my computer mouse, all of these things have petroleum products in it. And more, we're seeing that, the hard plastics and things like that, and even, pharmaceuticals and other things have in it some of, petroleum base to it. And so I think people need to realize that oil is not just what we consume in our cars, but it's something that is expanding in use as they find more opportunities to and create products for it. So I think that we're going to see, number one, the non-OECD be the biggest consumer increase, and then second, it'll be byproducts of energy that's also going to be increased demand, and I think that it's going to be a real wake up call to, by 2029, 2029, when people realize the industry cannot respond with a lot of new production. And that's when you see the price trajectory really go crazy to the upside. And as I said, I thought we could get over 147. Warren Buffett, who I think people know is a pretty smart investor, he says that oil is going to be in such short supply, it could be over $200 US a barrel. So, if he's willing to stick his neck out there, I'll stick mine at 147 and he can stick his out at 200. But I think the argument in favor of something like a long cycle commodity like this is simply because it's not just the discovery. If you're watching Landman, you might, on Paramount Plus, you get an idea of what the oil industry is about. But the reality is it's the infrastructure that becomes the impediment for the product to show up at market. And that's really what we will be watching in the years ahead, to see how those, and where the infrastructure is built. Because whoever builds the infrastructure will be the ones to see the demand growth, and those that don't, for whatever reason, will not see it.
Pretty significant, I think, to have Warren Buffett make that kind of call on oil prices. So thanks for bringing that up as well. And I think you mentioned natural gas prices a little bit as well, but just looking forward to 2026, what type of range are you looking? And I know it's tricky with all the weather related parts there.
Well, right now, as I mentioned, we're over 460 for NYMEX. You got cold weather. You've got big drawdowns. One of the things I watch is the U.S. natural gas numbers. And going back, 4 or 5 months ago, the inventories were at the high end of the 5-year range. They were 8% above the 5-year range. The data that just came out this morning showed another 166 BCF drawdown to 3.41. So we're now 3.8 below a year ago, but we're now 0.7 below the 5-year average. So that's the first time we've seen a negative number. And so if we have good drawdowns because of more LNG takeaway in the States, more data center use, inventories come down because of all of that, I think we could be looking at $5, $6 NYMEX on a regular basis. For AECO in Canada, we've had a glut in Canada. We've had high inventories. And now we've got LNG Canada over a BCF and probably 2 BCF in Q2 of 2026. They'll make an FID on the second, the second phase of it, LNG Canada 2, hopefully in Q2. And then all the others are moving through FID or starting to be built. So we could have an industry right now that's producing 18 BCF in Western Canada. It could have 6 to 8 BCF of incremental demand between now and the end of the decade. That's really the story. It's the incremental demand and the replacement of current production, so that you've got to have, number one, the industry is like treading, so it's not really growing. It's meeting the demand right now. But all of a sudden, you've got to add the demand of 6 to 8 BCF of more. The industry has to start drilling more, bringing on more, the infrastructure for it. And so it's to me, the stocks are trading right now at 2 to 3 times cash flow. At market peaks historically, like 2008, they were trading at 8 to 10 times cash flow. So if you go from, 2 to 8, that's a good multiple expansion. But then you take into account the commodity price going up, and so it goes from $2 to $5. That's going to help out. Production increases will help out. And then on the net asset value side, companies are trading at a third of their 2P NAV. So there's proved development, proved non-producing and probable. So the industry historically at the bottom trades at, at PDP, which is the low end. And at the top of the cycle, it trades at 2P. So we've got potential, 3, 4, 5 baggers just on those movement of the multiples. but then you take into account the incremental cash flows from higher commodity prices, and then you take the extra from production growth. I think there's 5 and 10 baggers on our buy list that we cover. We cover 31 companies. Some won't grow. There will be moderate growth because they pay 7-8% dividends. And the focus is on a little bit of growth, 5-6% growth and paying a 7-8% dividend yield, while others are focused on growth. And those are the ones that are going to be the home runs. And so we cover all of them because our client base wants, are older. They want dividend income, to replace, money market or bank, short-term deposits or T-bills. And then they also would like to see some growth, and they want a liquid company, low, great balance sheet, great management. So we try to cover the big boys that fit that bill. And then we go down the spectrum to the more entrepreneurial names, that people can get into. And just going back to, April, when we put out the buy signals, we had a lot of stocks that went up, 50% or more. Nuvista was 11, it's taken out by Ovintiv now at $18. You had, things like In Play trading at, 654. It's now 1227. Birchcliff, which is a big natural gas producer, was trading at 471. Now it's 758. So there's been some great performers out there. And so people should be looking at the sector. Go to the websites and look at their presentations. If they want to have, regular coverage, then, come to our website and become subscribers. But there's lots of opportunities, to get comfortable with the stories, because the companies will have presentations on their website. They'll have quarterly conference calls. And then we have as we've talked before, our Catch the Energy conference in October. And last year we had over 30 companies there, and people got face-to-face time with the company management of companies they owned or companies they were interested in. And that face time is very important for individual investors because it's the only conference in Canada, that really has a focus just on energy. The institutional market gets lots of coverage and lots of face time with management. Individual investors don't. And again, that's what you guys do. And that's what we do. And that's really important, is to have that, both the research side, which we provide, and the access to management. And that really gives, a very strong, comfort zone for people to follow the names, buy the names, and then be involved, by watching what the companies are doing.
Definitely, I agree. Those are two really important elements for investors to bring together. And on the note of the companies, I wanted to ask, so you mentioned, I believe at the beginning of the conversation, that a number of the names that you follow are now out of the story because of M&A activity. So is this an environment moving forward in 2026? Do you expect more mergers and acquisitions in the oil and gas sector?
Yeah, I think, it's the old story. Is it cheaper to buy than build? And so do you want to, buy land, drill up the wells, bring the production on, or is it cheaper to buy it on Bay Street or Wall Street? And right now stocks are so cheap. That's why we're seeing a lot of M&A activity, because it's cheaper to buy. And, Ovintiv came in and bought, from Paramount. Ovintiv came in and bought the Nuvista. You're seeing, Tourmaline make acquisitions regularly, ARC's making them regularly, CNQ's making them regularly. So I think, the consolidation of the Montney and Duvernay will continue, because that's the big, natural gas with liquids or natural gas with oil. And so people will want to own that sector. And then the other one is some of the light oil plays. I think the Charlie Lake and others. Clearwater is more of a heavy play. But if there's the plays that are producing more, where waterfalls can help, where there's growth in production, people will want to consolidate those areas. And I think we're going to see more of that. But the main action will be in the Montney and Duvernay. So that'll be in West 5, or the western part of Alberta, and Northeast BC. And that's where we're seeing the action in terms of takeovers. And I think that consolidation will continue in the next few years until the buy versus build decision goes in favor of build, because the stocks have gone up so much.
Well, and just a small follow-up, you mentioned there's been so much activity. In general, are you liking the deals that you've been seeing over the course of the last year or so?
Well, if you go into the oil deals, Meg got a a competitive battle there between Strathcona and Cenovus. In the end, the shareholders at Meg got a good price, and they could either take cash or shares in Cenovus. In the case of New Vista, it's a cash or shares of Ovintiv. In the case of Step, ARC's buying them out. ARC, the money management side of ARC Financial is buying them out. They were the major shareholder. Now they've taken it all in. And Kuwaitno got a private equity buyer that took them out. So I think that, M&A will continue both from the private equity side, but more so from big public players that look at the land spread and say, okay, I'm here and I'm here. Somebody's in the middle. That guy I want that asset. And so that's what we're seeing, from Ovintiv, where they're taking out, their neighbors and saying, we can operate it cheaper. We have the facilities and, we can lower the operating costs, make it more profitable, and we can get growth in volume. And so that's what's going to happen. And, Tourmaline has been an acquisitor over the years. Ovintiv is now, which used to be in Canada, now Ovintiv in the States. And I think we're going to see more and more ARC doing it, CNQ doing it. The big boys will continue to digest the middle guys. The middle guys will digest the small guys. And then the small guys will take out the money and build and start another company.
All right. Well, I think that we've covered quite a lot of ground in terms of oil and natural gas in this conversation. But before I let you go, is there anything we missed or any final thoughts that you would want to leave people with as we're heading into a new year?
Yeah, I think people should have some exposure to energy, be it, if they're conservative, it could be pipelines and royalty trusts, or the royalty companies, or if it can be, growth, with some dividend income. But there's lots of companies with 7 to 9% dividend yields even today. And if we get the correction I'm talking about, then we'll get them even at better prices. And we'll be sending out action alerts when that happens to subscribers so that they can take a look at the bargains that are available then. I think the sector in overall is cheap. It's cheaper than the United States. That's a very important point, is our stocks are cheaper than the U.S., part because of the political side that we talked about earlier. But I think that people should have exposure to the sector. And, if you're not exposed, people may want to just go to the big boys, CNQ, Suncor, Tourmaline, ARC. But if you have the ability to invest more, look at the medium-sized companies that are growing and look at the service sector, because as more utilization occurs in drilling rigs and in service rigs and in frac rigs or frac equipment, their ability to increase pricing goes up, and profitability goes up significantly. So, we ourselves have exposure to all of those, and we think people should consider, appropriately and sit down with their investment advisor and decide what's appropriate for you. But definitely look at the sector, because if I'm right, it's like a year and a half, ago in gold and silver, and we're just coming into the limelight, in the second half of 26.
I think that's a great note to end on. So thank you so much for coming on to review 2025, take a look forward at 2026, and we'll be sure to have you back soon so we can reevaluate where we're at.
My pleasure. It would be. Thank you so much, Charlotte.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Josef Schachter.